The U.S. economy is running hot again. And surprisingly, it's not because of consumer spending or housing. It's because of artificial intelligence. From Wall Street to Silicon Valley, the surge in AI investment is quietly rewriting America's growth story and could be the biggest economic driver of this decade. Let's break down how AI money is powering the U.S. economy, who's investing, what's changing, and why it matters for everyone from startups to workers. Over the past 2 years, corporate investment in AI has skyrocketed. According to new data, AI-related capital spending is now growing faster than any other category in the U.S. economy. The IMF recently reported that AI investment is actually shielding America from a slowdown, meaning even as other parts of the world face economic turbulence, the U.S. is staying afloat thanks to a tech-driven boom. What's behind this surge? It starts with infrastructure. Training large AI models, like those behind ChatGPT, Claude, or Gemini, requires enormous computing power. That demand has triggered a gold rush for data centers, cloud infrastructure, and semiconductor manufacturing. NVIDIA, for instance, has seen its revenue explode as companies race to secure GPUs. Meanwhile, firms like Amazon, Microsoft, and Google are pouring tens of billions into AI servers, specialized chips, and data facilities across states like Texas, Ohio, and Arizona. This investment doesn't just stay in tech. It ripples across the economy. Construction companies are building massive data centers at record pace. Electrical suppliers, steel producers, and even local real estate developers are seeing demand surge. In many U.S. regions, AI-related infrastructure projects have become the modern equivalent of manufacturing plants, creating thousands of jobs and injecting billions into local economies. Then comes the second wave, productivity. Businesses that adopt AI tools are reporting efficiency gains of 20 to 40% in areas like logistics, customer support, and analytics. For example, major retailers are using AI to forecast demand and optimize inventory, reducing waste and improving margins. Financial firms are using AI for risk modeling and fraud detection, while manufacturers are deploying predictive AI systems to minimize downtime on production lines. All of this contributes to one key trend: higher productivity with lower labor costs. That's why economists are calling AI the capital engine of this new expansion. It's not about adding more workers, it's about making existing ones more effective. But not everyone is cheering. Some experts warn this kind of growth can mask deeper risks. When too much money flows into a single sector, it can create bubbles, just like the dot-com boom of the 2000s. The IMF recently issued a caution that financial markets may be too optimistic about AI-driven returns, especially with stock valuations climbing to record highs. And there's another side to this: inequality. While big corporations and wealthy investors are reaping the benefits of AI, many small and mid-sized businesses struggle to keep up. Most lack the capital or talent to integrate AI effectively, creating a divide between AI haves and AI have-nots. The question is, can this wave of investment lift the entire economy, or will it concentrate wealth even further at the top? Still, the momentum is undeniable. The U.S. now leads the world in private sector AI investment, accounting for nearly 60% of all global funding in this space. Venture capital is pouring into AI startups focused on automation, healthcare, legal tech, and robotics. Many of these startups are becoming acquisition targets for big tech, sparking a new wave of innovation and consolidation. Even traditional sectors are jumping in. Energy companies are using AI to optimize grid efficiency and cut emissions. Banks are developing generative AI assistants for customer service. Retailers like Walmart are experimenting with conversational AI to power personalized shopping. And manufacturers are creating smart factories where algorithms monitor every stage of production in real time. The impact is spreading faster than anyone predicted. Economists estimate that AI-related investment could add up to 0.5 percentage point to U.S. GDP growth this year. That's a massive number in macroeconomic terms. And if the trend continues, AI could account for more than $1 trillion in new economic activity by the end of the decade. But the long-term question is sustainability. Can this level of investment keep going without overheating markets or widening inequality? Policymakers are already watching closely. The Federal Reserve is tracking how AI investment affects inflation, wage growth, and productivity. Lawmakers are debating how to regulate AI models without stifling innovation. One thing is clear: this isn't just a tech boom, it's an economic transformation. The AI build-out, from chips to data centers to applications, is creating a new industrial backbone for America. Just like railroads, electricity, or the internet once did, AI is becoming the infrastructure of a new economic era. So when people ask, what's driving the U.S. economy right now, it's not just jobs or consumer spending, it's silicon, data, and algorithms. The next great American expansion isn't being built in factories or oil fields. It's being coded in servers and powered by GPUs. And if history is any guide, the nations that invest early and build deep in new technologies tend to lead the world for decades. Right now, that's exactly what the United States is doing. AI isn't just reshaping technology, it's redefining the economy itself. The question is, how long can the boom last before innovation meets its first real test?